This is Switzer, still plenty more to come on the program. Here's a quick check of the market today, and the benchmark S&P ASX 200 index ending up 1/3% at 5,017. Now, a surge in the gold price and higher commodity prices helped the material sector lead the gains, while energy stocks fell. Okay, there's been a rise in the interest for loans, so can we view this as a sign that potential borrowers of Australia are becoming more comfortable with borrowing? Angus Luffman is General Manager of Consumer Risk at Veda, and he joins me in the studio. Angus, Veda, what does Veda do?
Oh, hi, Peter. Veda is Australia's largest credit reporting business. So we run a credit reporting, effectively a data sharing arrangement where lenders share credit reporting data. At the moment in Australia, that is about credit inquiries and credit defaults. And we then provide that out to credit providers or lenders again as when they credit check applicants for credit through financial services, even through a telecommunication or a utility contract.
So basically, people with really bad records, they're there, and people with good records are there as well. Yeah,
all are there. The information is at this point in time in Australia only negative, referred to as negative, and which is about inquiries, but it's a full inquiries.
That's going to change,
information. Yeah, it is. Where there's a change in the privacy laws, and credit reporting in Australia is encompassed in the privacy laws. That's going to change in March next year, where we'll go to what's referred to as comprehensive reporting, where other information, account information and repayment history information is shared with credit reporting businesses, and that really brings Australia into line with the rest of the sort of OECD nations or the rest of the world.
So could it mean that someone who, if you looked at them objectively, you might say they're hard to lend to because they look like they're vulnerable? But then if you looked at their repayment history of loans for the last 20 years, it shows that they've always paid their loans. Would that be a help for that sort of person?
Yeah, absolutely. There are
small business people would benefit from that.
Yeah. I think that it's going to be of general interest. The nature of the laws means it'll be around consumer credit specifically focused, and the benefit here is that there's obviously better information supports better decisions. That's the foundation of it. But the other point here is that someone who has defaulted on a loan, at this point in time, that stays on their record for 5 years, and that may be the only history that's presented apart from inquiry information. In the future, that could be corrected by saying that could have been just a point in life, a lost job or whatever.
Or something like that.
And then subsequent, you could show a period of repayment history that's positive or good for 6 to 12 months, and that shows a rehabilitation, and that closes down the cycle of getting credit. So it effectively shortens that credit cycle.
Now, there's been a quarterly consumer credit demand index, which you guys do. Why do you do it?
So what we do here is we measure credit demand, as we call it, and we're measuring their unsecured credit, which is personal loans and credit cards, and at the same time we measure mortgage demand. What's happening at the Credit Bureau here is we're looking at credit inquiries, or which come off applications for credit. And the reason we look at it as a demand index is because what it really does is it shows intention to spend. It's not that someone has taken out credit, it's the fact before that they've actually applied for credit. So they're making an active decision about spending, be it on a personal loan for a car or white goods, or using a credit card for credit card purposes. On top of that, same thing for mortgages, where we look at mortgage demand. We separate the two simply because typically unsecured credit and mortgage demand will move in different cycles. So
and are you saying then that your information should preempt what we actually see in the official data when loans actually happen?
Spot on. So it's a lead indicator, and a classic example of that.
That's why you did it, to be ahead of the game.
And we've seen, for instance, consumer sentiment came off, which is an asking a survey. In the quarter just passed, we saw our unsecured credit demand come off from the highs that had been previously. As an example.
Well, then let's just drill down to the big takeouts from the survey. Now, you mentioned that one. Then you said that consumer sentiment's gone off the boil. As indicated by what?
Oh, so just looking at those consumer sentiment surveys, I think there's a couple out there that you can look at.
Westpac's.
That show that. But what we saw there is our unsecured credit demand, or credit demand, came in at 4%. The last 2 quarters it's been 5%.
So it's come off the boil too?
Yep. And what we saw there is That's been really driven by a surge in car sales in the past 12 months.
Which could stop pretty soon.
Well, certainly there's some interesting commentary around about what could happen there.
Yeah.
And certainly we've seen that fade in this quarter.
Okay.
It has not been as strong in the June quarter.
Yeah.
And there was some mixed results in credit cards, but they've been fairly soft for a while now.
Yeah, it's been quite extraordinary the way Australians have rejected the credit card, and I presume there's been a big take-up in use of debit cards.
Well, I think there's just a range of effects we've seen there. There's the debit card piece. There was new laws that came in that made applying for a credit card a more sort of extended process. And then there's the general softening, consumer becoming more circumspect amongst the ones you could call out.
Yeah, personal loans, what's happening there?
Yeah, so personal loans, we've seen real strength in personal loans, and they're a pretty good indicator for what we see in particularly retail sales.
Yeah.
And because typically they're taken out for a larger good.
Yeah.
So it can be as big as a car, obviously, but obviously smaller white goods as well. So there's sort of more specific commitments to spend, specific drawdowns. That's been really strong. Predominantly we see driven by cars in the past 12 months, and that's come off. That's come off, somewhat.
So if you look at the trend on personal loans, it's been up, but it's now starting to tail off.
Yeah, still growing, but not as strongly.
At a slower rate.
Yeah.
So taking is there any other part of the survey which I've missed that you think was worth underlining?
Yeah, I think the separate one is the mortgage demand, where we've seen
quarters of declining or flat outcomes. We've had a strong positive outcome, which is up 7%.
Up 7?
Yeah.
That sounds like a good number. Is it a good number?
Yeah, it is. There's a couple of parts that are good to it. One is that it's not flat, so it's stronger. 2, it was nationwide, so the positive trend was nationwide. Those states that were already strong continue to be strong.
So Perth's not going off the boil.
So Perth was softer in the unsecured credit, and that's the one we'd tie closer to those economic factors. I think what we see in mortgage demand is a bit the same as what you'd see with property generally, which different pockets grow at very different rates. So we measure the survey on a state basis, and we've got survey results up near the 20s and survey results that are near 0. So they're in different states. So they're different outcomes.
Well, Angus, you've been in Veda, what, 12 years, you say? 11, 12 years?
Yep.
Okay. So can you use the kind of information you get to get a feel for the way the economy is going, whether it's heading up or heading down?
So what we've done quite a bit of work on this, Peter. We're doing this survey for 10 years. And certainly, as I said, in the unsecured credit, we certainly can see some linkages with retail sales, and certainly we saw a linkage with consumer sentiment in the past quarter. In mortgage demand, we see some really specific linkages over that time to housing turnover and housing price growth. So it typically leads by 2 to 3 quarters, those two factors.
So you expect housing to be a good story for the future of the economy, because once they get the loans, get the houses, the economic activity happens. But the stuff like unsecured personal credit is more like a now indicator, like are people going out and buying stuff now?
Yeah, well, it's shorter term, so that credit is shorter term by nature. So it's going to indicate those things. I think the mortgage stuff is, and we haven't called this out specifically because we can't get it from the data. I guess it's whether the mortgage stuff is pure turnover or the mortgage is then relating to construction activity, because that is then clearly gets into economics.
Okay, so now what I want you to do is give me a feel for where you think the economy is heading now, given this.
Well, I think so. On the unsecured credit demand, clearly that's come off. It's softer. There's a few changing dynamics. The Aussie dollar, which would link to the cars. So I think that would be. I don't see anything changing there this side of an election. Most clearly, and we're obviously measuring that in relatively tight cycles. And obviously, it's got some indicators for retail sales. The housing or the mortgage demand has clearly got some underlying momentum, and the other good thing about that is typically we've seen mortgage demand previously in more recent times being linked to stimulus. So either it's a change in a stamp duty law or a GFC type stimulus. This has come without those elements, and it's got underlying momentum in
Could be low interest rates, but mate...
we could always be part of it in that.
Fantastic. Thanks for joining us, Angus.
Great,
very
thanks,
insightful. Now, despite a positive year for the